All the time we hear about different investing narratives. 10 years ago, it was cannabis stocks. Then it was green energy stocks. And later on, it was electric vehicle stocks. It was a similar hype cycle where investors put their money into unprofitable companies with projected total addressable market of hundreds of billions of dollars. The results were always the same. Initially, the price skyrocketed, but eventually when the fundamentals didn't match that growth, stock price dropped and investors lost their money. Today we're going to discuss 3 different narratives that are currently pumping different sectors. The first narrative is nuclear stocks. AI models require massive computing power in order to be effective, and data centers require massive, stable power loads in order to run those models. The only reliable source of low-carbon energy at that scale is nuclear power. So far, it sounds quite compelling, doesn't it? However, nuclear plants require years of development, construction, and regulatory approvals. Also, the market is saturated, and we must not forget that energy is a commodity, meaning that we cannot expect high margins for those companies. Let's look at the companies that are supposed to produce and sell this energy to hyperscalers. One of the most commonly mentioned names is Oklo. Let's open it in StockPicker so that we can check what the company does. Oklo is an advanced nuclear technology company focused on designing, building, owning, and operating small advanced fission power plants, specifically its Aurora microreactors. Think of them as a company developing and deploying next-generation power stations that are smaller and more flexible than traditional nuclear plants. Their main goal is to sell electricity to customers like data centers, remote communities, and industrial sites through long-term contracts, essentially offering power as a service. All right, so currently Oklo is in a pre-revenue stage, meaning they are primarily focused on research, development, regulatory approvals, and constructing their first plants rather than generating significant sales from their powerhouses. For the first quarter of 2026, the company reported 0 in revenue. Their first commercial power plant is targeted to begin operations around 2028. So, this is a pre-revenue company trying to develop a small modular reactor, and they are targeting to generate revenue in 2 years. From my perspective, it is a great development that can benefit society if they succeed. But on what grounds did the stock move so much over the past year? Let's check the price action. The company went public through a SPAC merger back in 2024 and was trading between $10 and $30 per share. Last year, it moved up to $190 per share, and today it is sitting at $68 per share. My question is, what justifies a market cap of $11 billion? Nothing. They have a contract with Meta to supply them with 1.2 gigawatts of energy, which sounds great, but this is a long shot. They still need to get their reactor approved by the government and build the required facilities. Investing in Oklo is a moonshot. Hey, can you do me a favor? Please subscribe to my channel and click on the bell button. This would be the best way to support me. Let's look into a company that actually produces energy and is considered one of the primary beneficiaries of AI power demand, Vistra Corp. Vistra Corp, ticker VST, is a major player in the US energy market, operating as an integrated power company. This means they handle both generating electricity and selling it directly to customers. Their revenue for 2025 actually declined compared to 2024. The point is, energy supply is not elastic, especially when it comes to nuclear energy. Companies need to build new power plants and get regulatory approvals, which takes time. Vistra Corp has secured massive contracts with Meta and Amazon, but it will take time for hyperscalers to build the data centers and for these contracts to reflect on Vistra's top and bottom lines. The second narrative is quantum computing. It is widely believed that quantum computers can solve problems 10,000 times faster than modern supercomputers. There are publicly listed quantum computing companies like Rigetti Computing and D-Wave. The thing is, we're still in a research and development phase, and there is no commercial use of quantum computers yet. This means that pure quantum plays are still burning money, and we do not see any revenue from them. Let's open Rigetti Computing in Stockpicker. Rigetti Computing, with ticker RGTI, is a company at the forefront of quantum computing, which is a new type of computing that uses the strange rules of quantum physics to solve problems too complex for even the most powerful traditional supercomputers. The narrative is that Rigetti is a pioneer in quantum computing, poised to revolutionize industries with its powerful processors. The future is quantum, and Rigetti is a leader in building the hardware that will make it happen. Early investors are betting on massive future growth and disruptive technology. The reality is, while Rigetti is indeed in a cutting-edge field, the financial data shows a company still very much in the early, high investment stages with significant challenges in achieving consistent profitability and demonstrating a clear competitive edge. So there is no moat, which is obvious because they do not have commercial use for their product. We can see the price over the last year has fluctuated between $10 and $58 per share. The market cap is $8.5 billion, yet they generated just $4 million in revenue last quarter. As you can see, their revenue is not growing. What is growing here is the operating loss. They're burning more money every quarter, hoping to achieve the goal of a working quantum computer. These are high beta companies that can move 50% up or down overnight based entirely on headlines. They're also diluting shareholders. Their shares outstanding almost doubled in the last 2 years. Additionally, there is massive competition from hyperscalers in this industry. Companies like Google, Microsoft, and IBM are also developing quantum computers, but they have significantly more capital than quantum startups and can easily afford the development costs. Moving on to the hot topic, space companies. The narrative exploded with the expected IPO of SpaceX. The IPO would put the company at valuation of $1.5 trillion, which is totally disconnected from the fundamental metrics of the company. Let's open their S-1 filing and see what justifies this valuation. Our mission is to build the systems and technologies necessary to make life multiplanetary, to understand the true nature of the universe, and to extend the light of consciousness to the stars. Basically, their goal is to build a base on the moon and cities on other planets. We believe we have identified the largest actionable total addressable market in human history. We estimate that our quantifiable total addressable market is $28.5 trillion. Now let's check some of their fundamentals. Their revenue for Q1 of 2026 was $4.6 billion, which resulted in operating loss of $1.9 billion. So let's summarize. We're looking at an unprofitable company with a revenue of $4 billion that is seeking valuation of $1.5 trillion based on the assumption that they will extend the light of consciousness to the stars. This is not a moonshot. This is a Mars shot. And the worst thing here is that it would be included in Nasdaq 100 and S&P 500, so all the retirement funds and ETF investors can become backholders. Now let's look at Rocket Lab. Rocket Lab, ticker RKLB, operates in the exciting and rapidly growing space industry. Think of them as a company that helps get things into space and then helps those things work once they're there. Their core business has two main parts. Number one, launch services. This is where Rocket Lab makes money by launching satellites into orbit for customers. They primarily use their smaller Electron rocket, which is designed for dedicated missions carrying smaller satellites. They are also developing a larger rocket called Neutron to carry bigger payloads and potentially humans to space. They charge customers for each launch. And their second revenue stream is space systems. This part of the business is about building the actual stuff that goes into space or helps manage it. This includes making components for satellites, building entire satellites themselves, and providing services to operate spacecraft once they're in orbit. Essentially, if you need a part for your satellite or a whole satellite build, Rocket Lab can do it. Rocket Lab stock price moved up 440% over the trailing 12 months and is now sitting at a market cap of $83 billion. Their revenue for 2025 was $600 million, and the forecast is to reach $2.6 billion by 2030. That is an amazing expected growth of 400%. But at a price-to-sales ratio of 127x, it doesn't make the stock a compelling opportunity. Of course, the company is still unprofitable and is scaling its operating loss every quarter. They're also diluting shareholders. Their shares outstanding increased from 404 million to 605 million over the last 5 years. That's a 50% increase, and the trend is likely to continue. These are some of the narratives moving the markets these days. I am not saying investors can't make money with them. I am saying that price action is driven mainly by hype and media headlines. Usually in these cases, someone ends up holding the bag. I prefer companies where the bag holders are not other investors, but rather happy consumers that are spending their money every day with the company I own. That's it for today. Don't forget to like the video and subscribe to the channel. There's more coming.